Have you ever wondered why some property investments seem to flourish while others struggle? What if I told you there's a simple set of rules that can almost guarantee your success? Hi, I'm Michelle Cooper, property investor and owner of Aries Property Investments. Over the past few years, I've been dedicated to learning everything I can about property investment from some of the best educators in the industry. And now I'm excited to share these insights with you. When I first started exploring the world of property investing, I was overwhelmed by all the information out there. I saw friends and acquaintances jump into investments without a clear plan, and many of them ended up with properties that weren't performing as well as they'd hoped. I knew there had to be a better way, so I dived deep into the strategies that successful investors were using, and that's when I discovered the 6 C's. These are the golden rules that can help anyone make smarter, more profitable property investments. In this series, I'm going to walk you through each of the 6 C's. These principles are designed to help you avoid costly mistakes and ensure that every property you invest in is a high-quality, high-yielding asset. Whether you're new to property or looking to sharpen your skills, understanding the 6 C's is essential. Do you know why some tenants stick around for years while others seem to move out as soon as they arrive? It all comes down to the size of the property. Early on, I watched a couple of my friends dive into property investments with the idea that smaller properties, like 1 or 2 bedroom apartments, would be easier to manage. They seemed like a great deal at the time, and my friends thought they could buy more properties with their limited funds. However, what they didn't anticipate was the issue of transiency. One friend purchased a charming 1-bedroom flat in a bustling city centre. Initially, it seemed perfect, great location, easy to rent out. But what happened next was a pattern that became all too familiar. A young professional moved in, and within a year they fell in love, decided to move in with their partner, and suddenly the flat was empty again. This happened over and over, and each time my friend had to deal with the cost and hassle of finding new tenants, re-advertising the property, and sometimes even doing minor repairs to make it ready for the next occupant. Another acquaintance had a similar experience with a 2-bedroom house. A small family moved in, but as soon as they had a second child, they needed more space and moved out. The constant turnover wasn't just stressful, it was expensive. Each tenant change cost around £1,500 when you factored in lost rent, reletting fees and minor touch-ups to the property. Over a decade, this can add up to £15,000 for just one property, and if you have 10 properties like this, that's a £150,000 problem. I've learned from these experiences, which is why I now focus on 3 or 4 bedroom houses. These properties tend to attract long-term tenants, families who want stability, who are rooted in the community because their kids go to the local schools and whose relatives live nearby. I've heard stories from investors who rent to these lifers, tenants who want to stay for years. One investor told me how her long-term tenant called her up to ask if they could repaint the walls themselves. They weren't just renting a property, they were making it their home, saving the landlord money on maintenance and improving the property themselves. That's why the first C, capacity, is so critical. By focusing on 3 or 4 bedroom houses, you're more likely to attract families who see your property as a long-term home. This reduces turnover, cuts costs, and ensures a more stable income. It's a simple but powerful way to make sure your investments are both profitable and low maintenance.
Would you buy a property just because it's in a beautiful location? What if there was a smarter way to choose where to invest? I remember a conversation with a fellow investor who was thrilled about buying a property in a picturesque town. It was close to where he lived and he thought it would be a perfect, easy investment. But when we compared notes a year later, it turned out that while his property was in a lovely location, the rental income was much lower than he had hoped. On the other hand, another friend had invested in a city that wasn't as well known or attractive, but her returns were significantly higher. Here's a specific example that really drove this lesson home for me. I once had the opportunity to invest in York, a city known for its historical charm and beauty. For £150,000, I could have bought a 3-bedroom house that would rent out for around £700 a month. But then I looked at another option, Scarborough, a city that's not as famous but had strong rental demand. For the same £150,000, I could buy 2 3-bedroom houses for £75,000 each, and they would rent for £560 per month each. That's a total of £1,120 per month compared to the £700 I would have earned in York. Now, here's the interesting part. Over time, both markets rise at similar rates. If property values in York go up by 7% one year, Scarborough might follow with a 6 to 8% increase the next year. The difference is that while I wait for the market to rise, I'm earning an extra £420 a month in rental income. That's an additional £5,000 a year just because I chose the right city to invest in. Another investor shared a similar story with me. She initially bought properties in a small, picturesque town close to her home, thinking it would be a solid investment. But as the years passed, she noticed that her rental income was stagnating. Meanwhile, properties she had purchased in a less attractive but more economically stable city were consistently bringing in higher returns and appreciating faster in value. To summarise, the second C is city. Don't get caught up in the charm of a location. Instead, focus on places that offer the best return on your investment. Look for cities with strong job markets, affordable housing, and high rental demand. By choosing the right city, you'll maximise your rental income and see better long-term growth in your property's value.
Is it better to focus on immediate rental income or long-term property value? The truth is, you need both. I've come across many investors who were solely focused on the rent they could collect right away. They figured that as long as the property was bringing in money every month, they were set. But as I delved deeper into property investment strategies, I started noticing that the investors who were really successful were those who paid attention to both cash flow and capital growth. One story that stands out is from an investor I met who had been buying properties for several years. He was all about immediate cash flow and didn't give much thought to how much his properties might appreciate over time. He was doing well in the short term, collecting rent and paying his bills. But when the market started to shift, he found that his properties weren't gaining much value. He wanted to expand his portfolio, but he couldn't refinance his properties to pull out equity because they hadn't appreciated as much as he'd hoped. Contrast that with another investor who bought properties in areas with high potential for capital growth. She wasn't just looking at how much rent she could get today, she was thinking about how much the properties would be worth in 5 or 10 years. As the years passed, the value of her properties increased significantly. This allowed her to refinance, pull out equity, and purchase additional properties. Her portfolio grew much faster than the first investors because she understood the importance of capital growth. On average, if you pick the right areas, property prices should double in value every 10 years or so. I've learned that to truly build wealth through property investment, you need to focus on areas that offer both good rental income and strong potential for capital appreciation. It's not enough to just get by month to month. You want to be in a position where your properties are increasing in value, allowing you to leverage them for even greater gains in the future. The third C, capital, is all about ensuring your properties will grow in value. Invest in areas with good schools, strong transport links, and a healthy job market. These are the factors that will drive up property values over time, allowing you to build wealth and expand your investments. Remember, it's not just about what you earn today, it's about what your property will be worth in the future. What if I told you that one simple miscalculation could turn your dream investment into a financial drain? Cash flow is everything. In my journey, I've come across several stories of investors who were so eager to get into property that they overlooked one of the most important aspects: cash flow. One friend of mine bought a beautiful property in a desirable area. It seemed like a great deal, and he was thrilled at the thought of the rent he could charge, but he didn't take the time to sit down and properly calculate all the expenses. After a few months, he realised that the rent barely covered the mortgage, let alone maintenance, insurance, and other costs. He was essentially breaking even, or worse, losing money some months. I also remember an investor who jumped at the chance to buy a property because it was being offered at a significant discount. On paper, it looked like a fantastic deal. However, after factoring in all the costs, including a higher than expected mortgage rate and unforeseen maintenance issues, he discovered that his cash flow was much lower than anticipated. Instead of the profit he was expecting, he found himself struggling to keep up with the property's expenses. I've learned from these examples that it's crucial to calculate your cash flow before committing to a property. You need to ensure that the rent you collect each month is more than enough to cover your mortgage, maintenance, insurance, and any other costs. I always aim for a yield of at least 7.2%. This means that if I'm buying a property for £100,000, the rent should be at least £7,200 per year, or £600 per month. By carefully calculating your cash flow, you can avoid the stress of financial strain and ensure that your investment is profitable from day one. That's why the fourth C, cash flow, is essential. You need to ensure that the rent you collect each month is enough to cover all your expenses and still leave you with a profit. Aim for a yield of at least 7.2%. By carefully calculating your cash flow, you'll protect your investment and ensure it continues to pay you month after month. Imagine buying a property only to discover that no one wants to rent it. How do you avoid this nightmare? You check the market first. I've heard from several investors who got caught up in the excitement of buying a property only to realize too late that they didn't really know if anyone would want to rent it. One investor I know purchased a property in a small town that seemed promising. It was a lovely house and the price was right. But after closing the deal and listing the property for rent, weeks went by without a single inquiry. The few people who did show interest weren't the type of tenants he wanted. He ended up with a property that was sitting empty, costing him money every month. Another investor told me how he bought a property based on a hunch that it would rent out easily. He didn't do any research or check the local market demand. After the purchase, he put up a rental ad and got only a few calls, none of which turned into a lease. He was forced to lower the rent significantly just to attract tenants, which drastically reduced his expected cash flow. These stories show how important it is to test the market before buying a property. I've made it a rule to always run a test ad before finalizing a purchase. This simple step can save you from making a costly mistake. By placing an ad in the local paper or online, you can gauge the level of interest in your potential property. If you don't get at least 10 serious inquiries in the first week, it's a sign that you might want to reconsider the investment. The fifth C, check, is all about making sure there's demand for your property before you invest. By checking the demand first, you'll avoid the risk of owning a property that's difficult to rent out, ensuring your investment remains profitable. What would you do if, right after buying a property, something big goes wrong, like a boiler breaking down? Would you have the funds to fix it? I've spoken with many investors who were so eager to get started that they put every last penny into buying their first property. One investor shared with me how he spent all his savings on a property he thought would be a sure thing. But just a few months after buying it, the boiler broke down. He had no money set aside to cover the repair, so he had to borrow money just to keep the property running. This put him in a really tough spot financially and caused a lot of stress. Another investor I know purchased a property and didn't think to set aside any contingency funds. Everything seemed fine until a tenant stopped paying rent. Suddenly, she was faced with covering the mortgage out of her own pocket while trying to deal with the tenant issue. Without any savings to fall back on, she found herself struggling to keep up with the property's expenses, which nearly caused her to lose the investment altogether. These stories highlight the importance of having a contingency plan. I've made it a rule to always set aside 4.5% of my investment as a safety net. If I'm investing £100,000 in a property, I make sure to keep £4,500 in reserve. This way, if something unexpected happens, I'm not caught off guard. Having this contingency fund gives me peace of mind, knowing that I can handle whatever comes my way without putting my investment at risk. The 6C, contingency, is about setting aside a financial safety net. Keep some money in reserve to cover the unexpected. This small precaution can make a huge difference in protecting your investment and ensuring that it continues to generate income no matter what surprises come your way. If you stick with the 6 C's of property investing for family lets, you're not going to go wrong. Let's quickly recap. Capacity, choosing the right size property to ensure long-term tenancy. City, selecting the best location to maximise your return on investment. Capital, ensuring long-term growth through smart investment choices. Cash flow, making sure your property pays you consistently every month. Check, testing the market to ensure strong demand before you buy. Contingency, protecting your investment with a safety net for unexpected costs. At Aries Property Investments, we specialise in turning these principles into action. I offer tailored investment strategy development, creating customised investment plans that align with your financial goals, risk tolerance, and desired returns, giving you a clear roadmap to success. I prioritise secure investment handling, ensuring your investments are safe with our safe and secure portfolio plan. With Aries Property Investments, you can trust that your money is being carefully managed to achieve the best possible outcomes. Ready to take the next step? Let us invest on your behalf and build a profitable, sustainable property portfolio. Visit our website or contact us today to get started on your journey to financial success.